Well, good evening, everyone. This is Dan Mellis with Nexa Mortgage, and I thought I'd start. This is the first real meeting we're going to put together for the rest of the year. Is keeping track of a mortgage update for the day, and just seeing where the markets take us, and gives us a good idea of what's going on in the interest rate markets, the real estate markets. Today, we're going to be focusing on um, basically, you had Ralph Bostic's statement come out. You had Fed President Waller's statement come out. Pretty clear that the Fed is trying to jawbone rates and get a little bit more realistic here. We'll put that up on the screen and get a little bit more realistic take on um, so that the bond market won't get out of it, won't go crazy with rates continuing to go lower. So you have a little bit of give back. Today's statement by Bostic was basically that inflation must firmly and surely be getting back to our 2% target, and it would be a bad outcome if we started to ease and inflation started to rise and go up and down like a seesaw. That would undermine people's confidence in where the economy is going. Not as if they totally screwed up as far as inflation was concerned and calling it transitory inflation. Oh my goodness, talk about egg on the face. No, 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 that's not that's not going to undermine people's confidence in where the economy is going. No, no. But anyways, those are comments from Fed President Bostic, and you had some follow up on that from Waller, and basically the reason why what Bostic is saying is kind of laughable because we're at 2% right now. We're clearly at 2%. The run rate right now on CPI, if you take the last 6 months, okay, and so the run rate on on core PCE, I believe is running at 1.85%. So this is clearly just jawboning on the part of Raphael Bostic, in my opinion. You can see shelter makes it. We're taking a look here at core inflation, and you can see the shelter makes up 44% of core inflation. Of core CPI. It makes up 21% of core PCE, which is the Fed's favorite measure of inflation. And the problem with shelter costs is that they are lagging so much, right? I mean, shelter costs in the real world, which we're looking at the CoreLogic blended rent year over year change, and that peaked in the summer of 2022, right? And so actually even before that, it was in the spring of 2022. And so there's roughly an 18-month lag between peak inflation when you're getting that rollover in shelter change being reflected in the Fed's inflation definition. So if you took that lag effect into account, core CPI would be at 2.4%. Core PCE would be at 2.3%. So quite honestly, the inflation battle has already been fought and it's over with at this point. So the Fed is just trying to make sure that the markets don't get ahead of themselves. And so, in that vein, well, let's move over to the CoreLogic report because that did come out earlier today. And what you got with the CoreLogic rental report is that CoreLogic reported that rental prices are now up 2.7% year over year in November, which is a slight increase from 2.5% in the previous report. However, it is the first little uptick since May of 2022. So that's something to note, but it probably means overall that we've taken rental prices coming down. They probably hit as close to the bottom as they're going to hit. I don't know if they're going to bounce very much, but don't expect all that much progress moving forward. It's just going to become more reflected in the CPI numbers because of the lag effect. So I think that's a realistic take on things. The latest CPI report showing shelter costs rising 6.2%. And then when you took into the lag effect, we would be looking at about 2.3% on the core PCE. So anyways, If we move on here, let's see what we got here coming up. Oh, in the CoreLogic year-over-year percentage change by markets, if you take a look at, oh, for example, the Seattle market, it's not rising very much. I mean, the Seattle market right now is hovering right around just under 2% for the year-over-year rate of change in single-family rents and the single-family rent index coming from CoreLogic. Moving on, we had the New York Manufacturing Index come in today. Really weak. I mean, this is a really, really weak number. I think they were estimating they thought it was going to come in around -5, and it ended up coming in at -43.7. I mean, this is a big, big miss. And so you can see the weakness. We really do have a tale of two economies, and um, manufacturing is one tale, and then the service sector is a different story that we're getting. So we have a big problem in the manufacturing industry right now. Manufacturing is definitely in recession. The interesting part is whether the rest of the economy is going to follow suit. So we'll see. And that's why we're monitoring this every day going forward here. What you can also see here, I took a look at the 10-year Treasury index. You could clearly see that the downtrend has been broken. It got broken about a week and a half ago. And next slide's a little bit better. Next slide, here we go. Taking a look, in today's 10-year Treasury was up 11.6 basis points. Pretty big move higher, as you can see on the chart. And the Fed President Waller made the headlines talking about aggressive, tapering the aggressive Fed cut expectations. Well, here's the thing: they're trying to tamp things down. The next employment report, by the way, is going to be on February 2nd, so that's upcoming. And then the next Fed meeting is going to be on March 2nd. Well, there's only that many. We're talking about six. I think Waller was talking about we only expect six rate cuts this year, where there's not that many. They're every 6 weeks, and so you don't have that many Fed meetings to begin with. And so if they miss the Fed meeting and don't cut in March, they're going to basically cut, and the market will know this. They're going to cut for the rest of the year. So that's something that's reasonable to expect. What you can see here is that we've broken the downtrend line. If you take a look a little squig at the trend lines that we've got, and I drew in a Fibonacci retracement from the peak back in March 23rd with the peak in rates down to the low in rates. Came in on December 28th, if I'm not mistaken. And we are probably over the course of the next week and a half, going to continuously modestly higher rates, probably getting up to that 4.25% rate number before it hits pretty significant resistance. So we'll keep an eye on it. We'll see what happens. Hopefully I'm wrong and it goes right back down, but we'll see. And then lastly, we've got today's uh, mortgage MBS numbers. Again, we had an alert to lock at 9:37 Pacific time. I'm here in Seattle, and we were down 31 basis points on the day, and we are holding right now at the 50-day moving average, but we're probably going to be moving down towards that 100.487 support area, which would show up as support too. That's probably going to happen, which is roughly about 70 basis points, 80 basis points lower um, over the course of the next week or so. It's probably going to break support, which is where we're at right now. So we'll see. Hopefully I'm wrong. So anyway, that's about it for today. And I hope everyone's doing well. And thank you for watching. Talk soon. Bye bye.